So welcome to today's class. Today we want to look at, first of all, IFRS 5, and that is the last of the NCA standards that we've been doing. So we have, this one is non-current assets held for sale. And discontinued operation. So the standard is basically divided into two. So we have NCA held for sale and discontinued operations. So we are going to look at those two differently because it's not a combined thing, even though they are all covered by IFRS 5. They are kind of distinct in their presentations. All right. So what is NCA held for sale and what is discontinued operation? So as usual, let's split it into two and first look at what NCA held for sale is. And we'll be looking at the definition. I keep telling you that the definition helps you to know what you are dealing with. Because if you get to know that this is it, then you're able to apply the requirements under the standard. So first of all, what we want to do, as usual, is to define the term. So let's look at the definition. Now, what do we mean by NCA held for sale? When we say an NCA held for sale, NCA is a non-current asset. So we are looking at all those NCAs, all those non-current assets, or all disposable groups. Disposable groups. All right. Whose carrying amount? The carrying amount of those people will only be recovered primarily via a sale transaction rather than continuous use. So what you should understand in this definition is these terms. Okay, I will explain to you what a disposable group is, but the carrying amount, I think by now everybody knows carrying amount. So we are saying that when the carrying amount of that asset can only be recovered, you can only get that one primarily via a sale transaction. Because it's like you can only get the carrying amount back. You can recover its asset, not when you use the asset. Okay, if you sell the asset. When we talk about disposable groups, we are talking about all groups of assets, if possible, a liability that the entity has set aside with the intention of selling it. I mean, in one single transaction. So all the things you have in your entity that you group them together just to dispose them off. All right, just to sell them. All right, so that is what we call NCA held for sale. So the carrying amount of those assets are obtained via the selling of it. All right. Then after defining it, as usual, we need to talk about the recognition criteria. The recognition criteria. At what point do you say the thing or the asset is an NCA held for sale? Number one, of course, it's an asset. So you have two of the recognition criteria normally over there. But this one is different because you are not going to use it. So we cannot let you say probable inflow of economic benefit. Here, the probable inflow of economic benefit that you get, future economic benefit that you get, is coming from the selling of the asset. All right, so that is what we mean. All right, now, Now, what you're supposed to understand is that if something is held for sale, what are the things that can make us know that, okay, these people are not going to use the asset, but they are really going to sell it? Recognition criteria, then, number one, is that the asset should be available for immediate sale. Available for immediate, and please, the word is immediate. Immediate sale. Let me add, at its present condition. At its present condition. So all that the examiner needs to do is bring you a case where the thing is not really available at its present condition. It will tell you that it is available, but it's not at its present condition. That is what the examiner needs to do to confuse you. So be careful. Number two, because if you are saying you are selling the thing, when I come and I say I'm buying it, you can't tell me you need to do A, B, C, D on the asset before you can sell it to me. If you are going to do that, then you cannot recognize it as NCA held for sale. The standard says that it must be available for immediate sale at its present condition. You don't need to do anything more to it. All right, so take care of that. All right, then we come to the recognition criteria number two. It says that the sale must be highly probable. The selling of the asset must be highly probable. Must be highly probable. What do we mean by the thing being highly probable? What you should understand is that then it means that the management of the entity are committed. They are committed to a plan to sell the assets. There has to be a plan to sell the assets. In fact, there is nothing that you want to do that you don't plan to do. Now, if they really want to sell the asset or classify it as NCA held for sale, then they must have a plan. All right. If the sale is highly probable, they must have a plan. Number two, under this same must be highly probable for sale criteria, we say that there must be an active program. So there has to be an activity, a program. What we mean is an effort. There must be an effort to locate a buyer. You cannot tell me that you want to sell something when you are not doing anything to locate a buyer, i.e., kind of an advertisement. All right. So there must be an effort. All right. Now, the third thing under this same thing is that there has to be an active market. All right. So you have to actively market the thing, market the asset at a reasonable price. Now, you know that somebody who doesn't want to sell his or her asset, let's say your phone. I know that maximum these days iPhones are about, yeah, I know that maybe the latest one will price like for 12,000 or 15,000, right? Now, if I come to you and I say I want to buy your phone, and you now tell me that the price of that phone is like 50,000, you are just telling me that you are not ready to sell. I once had an experience driving at Temacomti 5 under the traffic, and there is this guy selling a wiper. When I got there, I asked the price of the wiper. As at those times, the price of a wiper maximum was 15 cedis. It was actually 10 cedis, but maybe you probably want to add something, so it's like 15 cedis, or worst case scenario, 20 cedis. I asked for the price of the wiper, and the guy told me it is 60 cedis. So I just rolled back my glass, and he said, "Oh, how much will I pay?" I said, "No, it's not about how much I pay. You know the price. Just trying to have your way. It's not like kind of wanting me to bargain for it. It's not a way I really want to go by, because there's a general market price. In an active market, the prices are displayed. Everybody knows the price. So you quoting an overprice It's just telling me that you are not ready to sell. Yeah. So I just walk away. All right. So that is that. Then number 3, in terms of the recognition criteria, what you should know is that the sale is expected to be completed within 1 year. Expected to be completed within 1 year. The asset is classified held for sale within 1 year, i.e. 12 months after you have classified the asset. So when you classify the asset as held for sale, the sale of the asset must happen within 1 year. All right. So the question is that, okay, say, what if the sale doesn't happen within 1 year? If the sale doesn't happen within 1 year after you have classified the thing as held for sale, you have to treat it back like the normal PPE, because there is something I will tell you when it comes to the measurements. All right. So something you do when you classify an asset as held for sale, because that thing is what is going to cause you the difference in treatment. I.e., what I'm trying to say is that when you classify an asset as held for sale, you don't depreciate it. You don't, and I'll come to that later. You don't depreciate it. So if you are not able to sell it after 1 year, you've classified the thing as held for sale, then it means that it goes back to your PPE. You then charge all the depreciation you didn't charge for that 1 year because you couldn't sell it. So we will do an example so that you see what I'm talking about. All right. Because when you classify it as held for sale, you don't depreciate it. And if by recognition criteria, we are saying that if you classify the thing as held for sale, you should be able to sell it within 1 year. But here, let me give a caveat to this, all right? Because sometimes you want to sell it, but so let me add here, unless there are circumstances beyond your control, all right? Unless one delays for that 1 year are caused by circumstances beyond your control. So check the case in the question very well. All right. And even with that, I mean, even where there are circumstances beyond the entity control, there has to be still sufficient evidence that the entity still wants to sell it, okay? All right. Notwithstanding the delay beyond your control, the entity must prove that it still wants to sell the asset. All right, so that thing must happen, okay? Then the last recognition criteria is the fact that the entity should not change their plan significantly from selling the asset. So we said that the unlikeliness, there must be the unlikeliness that the plan to sell the asset will change. All right, the plan to sell the asset will change. Okay, so I mean, these are things that you need to understand. But let me give you a warning that, and it's a question I want to ask, and I expect you to help me answer that question. If you have an abandoned asset, You are not using it. An abandoned asset, or what we call a wound down asset. Do you think that that asset is an NCA held for sale? Yes, what do you think? You are not using it. You have abandoned it. You have abandoned it. I mean, the house is just there. Do you think you can classify that asset as a held for sale? Yes, who wants to give an opinion? What do we do with an abandoned asset? Do you think we can classify it as NCA for sale?
Okay, let me try. No, we cannot classify it as held for sale because the recognition criteria that we just spoke of, there should be a plan to sell the asset, but just in case we have abandoned it, and it's like we have no use for it, so we can't classify it as such.
All right, thank you very much, and that answers the question. I mean, there is no activity that tells us that the people want to really sell it. Okay, so that is that. Thank you very much. All right, now we've done our recognition. The next thing we should do is to talk about the measurement. Now, the measurement has some similarities with IAS 36 when we were doing the impairment. It has some similarity in that. When we were talking about the impairment, we said that, okay, before I move on, let me do a big note. NCA held for sale are not depreciated. This is a big thing you must know. All right. Then we talk about the measurement. So I was telling you that if you remember what we did under IAS 36 impairment, we said that when we talk about impairment, what we said was that, if you remember, we said when the carrying amount is greater than what? Recoverable amount, right? And your recoverable amount, we said, was the greater of what and what?
The net realizable value, and then the fair value.
Yeah, it's value in use.
Value in use, yeah.
Sorry, net realizable value and value in use. And
yeah.
And realizable value is the fair value less cost to sell. All right.
Yeah.
Now, what you need to know is that over here, we are saying that an NCA is an asset whose recoverable amount or whose carrying amount can only be recovered via sale. So there is nothing like value in use. You don't use it. So there is nothing like value in use. Please take note of that. So therefore, automatically, your recoverable amount that you have here is only what? This one. This is it. That is what will be left. As a matter of fact, if here is 0, any number that is here is greater than the value in use, and therefore that will be the representation of what? Your carrying amount. And so in NCA held for sale, we say that in measuring it, so our measurement is the lower of the carrying amount and the recoverable amount. So it takes you back, and the recoverable amount will only be this one. So it will be your fair value less cost to sell. That will be it, because there's no value in use. And please watch this. If your NCA or your CA, sorry, your carrying amount is 5,000, and it happens so that this side is 4,000, what do you see? Who can tell me what the person sees? What do you see? What can you tell us?
There is impairment of loss.
There is impairment. There is impairment. Thank you. But you see, the standard we are doing is IFRS 5. We are not doing impairment, but you see that there is impairment because this side becomes your 4,000. And we are saying that you have to pick the lower of the carrying amount and the recoverable amount. So if this one is the one we are picking, then it means that there is impairment of what? 1,000. So anytime in an NCA for sale, your recoverable amount becomes lower, there should be a recognition of impairment to your SPL, and your recoverable amount becomes your SOFP figure. So you should be able to spot that. So whenever there is a question that comes into your exams that you really see that you are doing NCA held for sale, bear in mind that there is also impairment. And that is where you guys need to be careful. We call them composite standards. You think you are doing standard A, but there is standard B also inside. All right, so please take note of that. Take note of that. So that is something you need to spot. And that is a key issue number 1 that you need to spot. Key issue number 2 is what I've already told you here. This side, there is no what? Depreciation. You don't depreciate the asset. All right. Let me now point out key issue number 3. Key issue number 3 is about if the asset has been revalued before, it is being classified as a NCA for sale. So if you have a particular asset that is measured at fair value or revaluation model, and it's now classified as NCA held for sale, then what the standard is telling us is that it should be revalued as per IAS 16 or IAS 40 before the classification is done, before that reclassification is done. So remember, so we are saying that if a particular asset, that particular asset, so if an asset, all right, is measured using the fair value model, and I think by now everybody knows the fair value model or the revaluation model, all right, that asset, so we have a fair value model, a revaluation model, and that asset is now reclassified as NCA, it's now to be reclassified as NCA held for sale. Let me add that, and that asset is now to be, it's a future statement, to be classified as NCA held for sale. Then that asset must be revalued before the reclassification is done. That asset must be reclassified or revalued before the reclassification to NCA held for sale. To NCA held for sale is done. All right. So that is that. Now, when you do that, when you do the revaluation, okay, any revaluation gain, all right, that you get there, any differences in revaluation that you get there will go to your P&L, and that is it will go and match the impairment loss that is existing. So any differences in revaluation. So differences in revaluation. Goes to the SPL. All right, goes to the SPL against profit. All right, and if it's kind of an impairment against your profit or your impairment losses. So if it's a revaluation gain, then you are matching it against impairment losses. If it's a revaluation loss, then it's a match against profit. So those are the things that you should understand. Then the last thing you should know is that any subsequent gain or revaluation that you would do again, all right, should not exceed the impairment loss, cumulative impairment losses that you have done. So what I'm saying is that, so you have here revaluation loss. So the last point is trying to say that if you have subsequent gains, all right, from revaluation, should not exceed impairment losses, cumulative impairment losses that you have already recognized. So you check all the impairment losses that you have done. Any gain should not exceed it, i.e., you are going to match it against all impairment losses that has ever happened before. All right. So either the assets were written down to recoverable amounts or previously impaired. What you need to check is that all the revaluation that you are getting, revaluation gain. So let me say subsequent revaluation gain, revaluation surpluses. All right. All right. In the new figure that you have, which is your carrying amount, the lower of your carrying amount and fair value less cost to sell, whichever one you have, any further revaluation that you do, all those subsequent gains in those revaluation shall not exceed cumulative impairment. All right, so basically, that is that. So these are the 4 key things you must know. Please, NCA for sale are presented at your current assets. All right, that's the last item as your current asset. So please take note of that. That is where it is presented. If you check your IAS 1, you will see, okay, this is presented as part of current assets. So take note of that. If you have something classified, so that is that. But another thing I need to tell you is that if the reclassification of the NCA held for sale is done after the reporting date, before the financial statements are authorized for the issue, a disclosure must be made. And so we are saying that it is a non-adjusting event, okay? If it is done after the end of the reporting date, but before the financial statements are authorized for issue, please, it's a non-adjusting event. Just disclose it. All right. So please take note of that. So basically, this is all you need to know about NCA held for sale. Everything that you've done here goes the same thing for the disposable groups. All right. It's the same thing. It's the same thing. All right. So if like I was saying, the key point that I was trying to make, if 1 year has come and you have not been able to sell the asset, let me make that thing very important. It's a key thing that you should know. So if you classify the thing as NCA for sale, but you realize that you couldn't sell it within 1 year, or you no longer meet the recognition criteria, then you should cease it as NCA held for sale. You should cease the treatment of NCA held for sale, meaning that you need to go back and add all your depreciation or amortizations. Okay, so if recognition as NCA held for sale is no longer met, all right, the assets will have to be measured at the lower of cost and fair value, less cost to sell. That one we know. But so what we are saying is that you will have to remeasure. So measure the assets is now measured at the same thing we had there before. We have carrying amount. Remember, it's measured at the lower of, now measured at lower of the NCA, the carrying amount and the fair value less cost to sell. Now, what you need to do, fair value less cost to sell, is a new date. So at the date of the subsequent decision not to sell, at the date, because it's a different date, 1 year be updated, and you know that fair value is always the current price at which the thing can be exchanged. All right, at a measurement date. That measurement date is the new date, not the old date is a new date. All right, so you have to remeasure it. That is what we mean. All right, so at the date of subsequent decision of not selling the asset, date of subsequent decision not to sell again. And the carrying amount too has to be adjusted. The carrying amount, you have to adjust it for the depreciation that you didn't charge. All right, or the accumulated depreciation that you didn't charge because you classified the thing as held for sale. All right, any amortization that you didn't do because the thing was classified as held for sale. All right, so please, ladies and gentlemen, this is NCA held for sale. Now, we have another part of this standard, which is called what? Discontinued operations. Discontinued operation. But as far as NCA held for sale is concerned, this is where we talk about it. So if you have any question, you will ask, because very soon we are going to bring up some examples for you to see, computational examples for you to see how it operates. All right, but as it stands, this is what NCA held for sale is about. So if there is no question, what I'm going to do is to give you a brief up of how discontinued operation is. All right, it's a very short thing. So let's look at the second part of the standard, which talks about discontinued operations. All right, now when we talk about discontinued operations, what we are saying is that we are looking at a component of an entity. Component of an entity. All right, that has been disposed of or classified as NCA held for sale. Yeah, so basically we are talking about a component of an entity, all right, that has been disposed of or classified as held for sale. All right, so that is what a discontinued operation is. And as a matter of fact, it represents the, 2 years, 3 years, 4 years, 5 years, 6 years, 7 years, 8 years, 9 years, 10 years, 11 years, 12 years, 13 years, 14 years, 15 years, 16 years, 17 years, 18 years, 19 years, 20 years, 21 years, 22 years, 23 years, 24 years, 25 years, 26 years, 27 years, 28 years, 29 years, 30 years, 31 years, 32 years, 33 years, 34 years, 35 years, 36 years, 37 years, 38 years, 39 years, 40 years, 41 years, 42 years, 43 years, 44 years, 45 years, 46 years, 47 years, 48 years, 49 years, 50 years, 51 years, 52 years, 53 years, 54 years, 55 years, 56 years, 57 years, 58 years, 59 years, 60 years, 61 years, 62 years, 63 years, 64 years, 65 ye a separate major line of business, okay? A separate major line of business. So we are talking about a department or a unit, okay? Separate major line of business. So like a unit, a CJU, all right, those kind of things. Also, not only in that manner, but it can be a part of a plan. It may represent a part of a plan, all right, part of a plan to dispose of a separate major line, to dispose of a separate major line of business. All right, so it's either a separate major line of business or a plan, all right, or, and this one you may meet it when you come to level 3, a subsidiary you've acquired solely for the purpose of resale. Subsidiaries acquired solely for the purpose of resale. So you buy the subsidiary solely for the purpose of resale. All right. So those, if it is like that, then it is classified as what? Discontinued operation. Now, all you need to know is that what I'm going to show you is simple. Then I'll show you the presentation. You see, you have the P&L that you know, as you've been preparing all this while. It is actually called P&L for continuing operation. Why do I say that? Because there is an underlying assumption for that P&L that you prepare that says that the entity is on a going concern. Do you remember? So if it is a going concern, then it means that it's a P&L for a continuing operation. Now, what you should understand is that if it is not going to be on a continuing operation, then it means that it is disposed, or it is actually targeted to be disposed of. So we say it is classified as what? NCA, held for sale. All right. Now, not NCA, sorry, an operation held for sale, or a segment held for sale. So because of that, what you are going to do is that you are going to prepare a P&L for that aspect of the discontinuing operation. So what I'm basically saying is that you have a P&L for continuing operation, the one that you have done, called on a going concern basis. Then you have to do another P&L for the discontinuing one. Okay? The discontinuing operation. You have to do a P&L for that one. Now, once you finish doing the P&L for the discontinuing operation, you will definitely end up having some profit after tax, profit or loss after tax, all right? Or loss after tax. You will definitely have that. Now, once you finish that, you see here too, you will have your profit after tax, profit or loss after tax, okay? So we call it profit or loss after tax of a continuing operation. Then whatever you get here has to be presented as a one-line item, all right? One-line item in the P&L. So that is what you should understand. You present it as a just one line item. So after you've gotten your profit or loss after tax from continuing operations, you will now come and add this side. You say profit or loss after tax of discontinuing operations. So you have those two figures, and this one is called the overall profit. All right. So that is what you are supposed to understand. All right. Sometimes too, you see, we said it's either you have presented this thing. If you check what we said here, it's either you have actually presented it as you've disposed it of, or you've classified it as held for sale. This thing we've done is telling you when it is classified held for sale. What if you dispose it of? If you dispose it of, it's the same thing. You will sell it, and so you will get a profit or loss from selling it. And that one too is the same thing. You present it here as a one-line item, all right, in your P&L. All right. So basically, that is that. All right. Any question? If there is no question, we will have to be looking at some examples, computational examples. Yes, any question? So think through. If you have a question, bring it on board. All right. So let's try these questions. So those of you who have your study manual, but you see that there are some questions in your study manual you need to be able to carry on and deal with that. But let's do a few. Let's do a few. So let's look at the question that we have here. So we have Trent Alexander Arnold, who bought an asset at the cost of 120,000 on January 2021 and depreciated on a straight line basis over the 10 years. The asset has a nil residual value, and it is the depreciation is charged on pro rata on monthly basis. So be careful. These are issues you need to take keen interest in. Now they tell you that on November 2014, Trent Alexander Arnold now classified the asset as NCA held for sale in accordance with what? IFRS 5. Now at that date, the fair value of the asset was now 70,000, and the cost to sell was 2,000. The asset had not been sold at December 2014 reporting date. So this is the date they classify it. If they've not sold, it's just 1 month. Remember, we have 1 year. All right. So how do we approach this? How do you approach this? Yes, who is willing to help? How do you approach this? Who is willing to help? So remember some of the things that we spoke about. It said that if you have an asset that is using the fair value model or the revaluation model, before you reclassify the asset, you must what? Revaluate. Do you remember that point we made? Those were the things we had before. If it is not, then fine, you are good to go. You do what you have to do. Now watch this. If you watch this one carefully, we are told that on January 2011, there is an asset bought which is 120,000. So that is our cost, the cost of the asset. We are also told that the depreciation is 10 years, which means that every year will be how much? I think 12,000, right? Depreciation per year will be what? 12,000. But we are also told to be careful because they do the thing on monthly basis. But we could see that our accumulated depreciation, if you want to work it, will span from January 2011, okay, to let's say December 2013, right? The previous year's counting. So 2011, 2012, 2013. So that is what we will have to 2013 December. And that gives us 3 years. So we have 12,000 by 3 years. How much do we have? That gives us what? 36. That's it, right? Guys, I hope you are with me. So if that is correct, what will be our opening NCA for 2014 year. Yes. Opening carrying amount. How much would that be? Please point the calculators and let me have it. Then we need to find 2014 depreciation. Yes, who is giving me the answers?
$84,000.
84,000.
Mm-hmm.
All right. Now that we know that depreciation per year is 12,000, but we are also told that on monthly basis we need to check. 2014 will be 12,000 multiplied by, it's on which day did they do it? Here. They did it on, so we have to do that by 11/12. Is that not it?
Yeah.
And how much would that give us?
11,000.
I think it's what?
11,000.
11,000. All right. So as at the time we are reclassifying the thing as NCA for sale, how much do we have? 73,000. Is that correct?
Yes.
All right. So that is the carrying amount that we have. Now, the fair value less cost to sell is how much?
70,000.
No, 70,000. 70,000
minus 2,000.
exactly. So we will have 68,000. All right. So it tells us that this is what we need to pick. Remember, we need to pick the lower. Do you remember? So
Yes.
this is what we put to our SOFP, and the difference of how much? 5,000, right?
Yeah.
Is an impairment loss. Have you seen how it goes? That's it. So remember, we have 1 month not treated for depreciation, but because it is now an NCA held for sale, we will no longer depreciate it for that 1 month. Do you know that? No depreciation for December because it is classified now as NCA held for sale.
Hello, boss.
Yes, sir.
Yeah. What about the 11 months that is left? Because the asset was in for 11 months.
Yeah, this in 2014. This is our depreciation.
Oh, okay.
So in your SPL, you have depreciation.
Okay.
And you have impairment loss, and this is your SOF.
Thank you.
All right. So that is how it is. Now, what I'm going to do is to allow you guys to deal with the question 2. All right. To deal with the question 2. All right. So I'm giving you 5 minutes. Work your question 2. All the best. All right. Let's go.
Yeah. The cost of the asset is 20,000.
Yeah. So we have cost of 20,000. Okay.
Then the depreciation, they say the asset has a useful life of 10 years.
Okay.
That is fair value. So per annum will be 2,000.
So accumulated is what?
Accumulated depreciation for the entire period or for 2011 to 2012.
Yeah, it will be 2012 because your current year depreciation must be separated from the accumulated.
That will be 4,000.
Okay, so 2 by 2, right?
Yeah, 2 by
All right, so that gives us 16.
16.
Uh-huh.
Then the decision was made in 30th September.
Okay.
So that would be 9 months.
Okay.
That would be 1,500. It will be 200 times 9/12 times is equal to 1,500. Then the carry amount, the closing carry amount will be 14,000.
I'm listening.
And then you now look for the recovery amount. The recovery amount will now be the 13,500 minus the cost of sale. Which will be 1,300.
13,000.
Yeah, 13,000.
All right.
So the amount to be sent to the statement of surrender position will be the 13,000. Then we now compare it with the carry amount.
Okay.
To look for impairment. So there's impairment of 1,500.
All right. So basically that is that. Thank you. All right. We've done the discontinued operation. So like I was showing you, remember, so you do the P&L, you do everything. You see what you've done. This is the P&L for continuing operations. Then you add profit or loss from discontinuing operations. Then you have your profit or loss for the year. This thing, when it comes in your exams, feels like you are doing double P&L. So hardly does it come. It doesn't come usually, because when it comes, it means you need to do double P&L, one for continuing and one for the discontinuing, before you can bring the discontinuing one as part of your continuing one. So hardly does those ones come, because, like, for instance, you look at this question, we are told that Konate produced yellow and sold red. That is what he does. Halfway in the year, the 1st March 2016. The red business was closed. So it means that you need to close the red business by doing the P&L for the red business. You have your revenue, you have your cost of sales. Okay. Then you have your distribution expense, your administrative expense, finance costs, or other trading expense to be allocated to the continuing operation. So this one is not for the discontinued operation. So it means you need to do this 320 minus cost of sales minus these things. Whatever you get, all right, so you need to do that. They said that the red was closed and sold off, you see. So you will do this thing. I think somebody can just punch and give me the figure. And they said it was sold. You realize that the non-current asset for that the company was 76,000. They also incurred redundancy cost, all right, of what do we call it, 37,000. The directors recognized continuing operation at the directors recognize the continuing operation as the 98. So it is just trying to tell you that those parts that they were continuing, I mean, it's supposed to be discontinued operation. So probably when you sell it, you see, this is your asset and you are incurring this cost when you dispose it off as a redundancy. So it's another cost. Then this is what you get. Says that the directors recognize this thing, the continuing operation at 90. Okay, if it is the continuing operation, then we don't do anything with that. All right. As for that, it's a continuing operation. But why will you recognize something? I think that there is an error here. I'll check for you. Because if they sell the discontinuing operation, then it means that there is a cost here. There's a cost here. This thing is what they've realized. All right. Then you do the difference. Then you get a gain or loss. But what I'm trying to show you is that continuing and discontinuing. Okay. Then you bring the discontinuing P&L as part of the continuing P&Ls, like a one-line item over there. And that is why the question says here that explain how the presentation will be done. The presentation is to what? Bring it as a one-line item. I told you that if you dispose it of, the gain or loss, all right, comes as a one-line item, and also the profit after tax from the discontinued operation also come as one-line item. All right, so basically that is what you need to know. All right. So you have more examples. So with the one that we've done, this is the one that we did. If you remember the first one that we did, this was it. This is the one you just did. All right. So even here, depreciation did not show. And the one that you are looking at, the question 3, this is how your discontinued operation will be like, and your continued operation will be 4, profit. If you look at it, I think it's clear. Look at, if you take this, less this, less this, less this, less this one and this one, I think you get what they are referring to. All right, so the final answer. So those of you who have the manual, go through it and do it. So what you need to know is that there is also depreciation aside this impairment loss, as we have seen here. All right, the depreciation of 1,005. Oh, this one is our depreciation for the year. There's 1,005. Impairment loss is also 1,005, and you have this 13,000. So that is what you are supposed to know. So, ladies and gentlemen, that ends our class on IFRS 5. Any question on that, I'm willing to take and answer.